Hello and welcome to another Deep Value video. Today, an in-depth look at Infosys Limited, ticker symbol INFY. We'll dive into the financial metrics, assess the company's growth, and ultimately try to find its fair buy price. Infosys Limited is an Indian multinational technology company that offers business consulting, information technology, and outsourcing services. The stock is priced at $23.3 with a market cap of 95.3 billion. Now let's dive into some key valuation metrics. The company's price to earnings ratio stands at 29.7, and the price to cash flow ratio is 27.2. To see how the market usually values the company, we'll look at the median PE over the past 10 years, which was 21.5. Now let's look at the company's growth rate. The company's revenue has grown by 45.2% in the past 5 years. Its bottom line has increased by 35.8%. In terms of earnings per share, there has been a growth of 38.2%. And notably, the number of common shares outstanding is 4.14 billion, reflecting a minus 2.8% change over a period. Now, let's assess the company's liquidity and solvency. The interest coverage ratio is 66.7, indicating the company's solid ability to handle its debt obligations. The quick ratio, a measure of the company's short-term liquidity, is 1.88, which is very good, in my opinion. It suggests that the management is very capable in terms of managing their balance sheet. Additionally, the long-term debt equity ratio is zero, and the total debt equity ratio is zero. This is extremely good because they basically have no debt, and this helps management to protect themselves from high interest environments. I believe that there is a very great advantage to having zero debt because if, for example, the interest rates worldwide drop to 0 or 1%, so pre-COVID levels, uh, then they could take out a lot of debt to invest further. But I don't see why they would invest. I mean, having zero debt is fine, and because they're a consulting company, there isn't really much to invest in. But yeah, let's continue. Shifting into the cash flow statement now, cash from operations stands at 3.15 billion, reflecting a growth of 18.3%. Cash from investing activities is minus 700 million, with a plus 192.5% change, while financing activities are at minus 2.1 billion, showing a minus 15.8% change over the same period. CapEx has also decreased by 42.8%, and free cash flow has grown by 6.5% to $1.47 billion. Moving forward, let's look at the return metrics. We see how the company is utilizing its resources. The return on equity is 32%, which gives us an idea of the profitability relative to shareholders' equity. The return on investment is not calculable because they have zero long-term and short-term debt, so you can't really calculate a return on investment. The return on assets is 19.7%, both indicating how efficiently the company is generating returns from its investment and assets. And additionally, the return on invested capital stands at 24.3%, a very high return on invested capital that shows very promising signs for the company's future. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis, placing a discount rate of 9%, a revenue growth rate of 8% for 10 years, and perpetuity growth rate of 2%. We get a fair value of $20.2. Secondly, using a multiples valuation of 20 times earnings, operating cash flow, and 25 times free cash flow, we get a fair value of $14.7. Thirdly, the analyst target price is $23.2. And putting it all together, we get an intrinsic value of $19.4. Using a 15% margin of safety, get an acceptable buy price of $16.5, suggesting that the stock at the current levels is overvalued. To wrap up my analysis, I rate Infosys as a whole. But uh, this is not without the mention that this is a very good hold, and the only reason I don't believe that they're a buy is that although they're very well operated, there isn't really much room to grow your investment. So for 8% annual growth on their revenue, that means that you shouldn't pay a 30 times price to earnings. If the price drop to sub 18 levels, then the stock price would make much more sense. I mean, at sub 18, this would be an instant buy because of their non-existent debt. They're promising medium level growth for the foreseeable future. Also, the fact that they're in India, which is a country that has huge growth potential and is growing very fast. So that is a big boost to their bottom and top line. All in all, this is a great company, but just not at the right price yet. If this drop to sub 18, then yes, I rate it as a buy. Of course, do your own due diligence, but this is just my opinion. And I believe that there's such a well-run company, but the price just isn't right yet. Now, thank you for watching. If you found this video helpful, please like and subscribe for more development analysis. See you in the next video. Bye.